From the financial centers of the world, this is Bloomberg Markets with Alix and Guy Johnson.
It's 30 minutes into the U.S. trading day, Monday, June 13th. Here are the top market stories we're following for you at this hour. Risk assets, they're selling off. They're selling off big, from stocks to commodities. Investors are pulling out of the markets in a huge way. Yields driving the narrative and strengthening the dollar. What peak? Inflation concerns dominating market fears once again after Friday's CPI report showed March wasn't the peak. What can the White House do about rising costs? We're going to talk to former chair of the Council of Economic Advisors, Austan Goolsbee. A fascinating conversation ahead. And Bitcoin at 23,000, not much of an inflation hedge. Bitcoin trading back at levels last seen at the end of 2020, dragging down the entire cryptocurrency complex with it. From New York, I'm Kriti Gupta, in for Alix with Guy Johnson in London. Welcome to Bloomberg Markets. Guy, already only about 30 minutes into the trading day, and it's been a pretty ugly open.
It's not the kind of Monday you were hoping for, but I guess after the Friday we just saw, without the Fed to kind of step in and calm nerves, maybe this is to be anticipated. We are obviously seeing the Fed still in purdah. We wait the rate decision a little bit later on this week. The question we're trying to figure out, and we've been debating, and I think this is the conversation that everybody's having right now, and it's been happening since that inflation print Friday, is 75 basis points back on the table? And if 75 basis points is back on the table, where does that take us? How should we price that? How should we be thinking about this? The terminal rate is rising now up to around circa 4%. We await Jay Powell. And are we in a period of instability until we do? Let's ask Michael McKee, Bloomberg's international economics and policy correspondent, and Gina Martin-Adams, chief equity strategist at Bloomberg Intelligence. Mike, I'm going to start with you. We have a quiet period. We don't know what the Fed is going to say at the end of it. How big a game changer was Friday? And do you think we're going to need to hear from the Fed before these markets stabilize?
Well, I think Friday was a big game changer for the markets, but not necessarily for the Fed. And the thing that comes to mind about the whole thing is, who needs the Fed? The markets are already reacting. And that's what's happened throughout this cycle, is the markets have front-run the Fed based on what they think is going to happen. Now, Fed doesn't like to surprise markets and has said they would do 50, so there's probably a pretty good chance they'll stick with that and do 50. But then we could get Jay Powell saying, yes, 75 is on the table if we need to. And that'll just spur some more selling, and yields will continue to rise, and we'll see the front running, and the market will be doing the Fed's work for it without the Fed having to go that high. The real question for Wednesday is, what's the terminal rate? How high are they going to lift that dot in the final dot in the dot plot? Where do they think they need to get to? Because then people will work backwards from that, trying to do the math on when they start to raise rates by how much.
Gina, hop on in here, because something that has been really a trademark or a hallmark of what we've seen so far is the markets front-running the Fed kind of playing a little bit of a catch-up. If markets are indeed perhaps putting 75 basis points back on the table, what does that mean for the stock market?
Well, it's meant extraordinary weakness Friday and again today. As we price in that potential outcome, we also price in a much faster pace of future hikes as well, as we're starting to price not only 75 basis points for the coming meeting this week, but also much more even preceding September. So I think the market is reacting to inflation at the same time. I mean, consider that there's a sort of dual reaction happening in the equity market. The absolute prospects for Fed impacting valuation multiples, but then the real data in the form of the inflation prints impacting margin estimates, which are impacting earnings growth forecasts. So the equity market is experiencing this sort of dual pressure, reflecting what we experienced on Friday in terms of the CPI and anticipating further inflation pressures to emerge with the PPI and import price prints coming this week.
Gina, can I just talk a little bit more about that? Mm-hmm. The market, it strikes me, is saying a number of things at the moment. One of the things it's saying is that the Fed is still massively behind the curve, and as a result of which it's going to have to do more. If the Fed is able to deliver the perception that it is getting at least at the curve, beyond the curve, would the market react positively or negatively? I.e., if the Fed came out and did more, would the equity market, would risk assets react positively to that or negatively to that, compared with, say, if they came out and did less, i.e. 50? So this is the 75-50 debate.
Yeah, God, it's a complicated question because I think there's more than just the Fed impacting the market right now. I do think that there is this psychology getting embedded in the equity market that suggests the Fed is behind the curve, and the longer the Fed remains behind the curve, the more deeply embedded inflation expectations become, and the more secular transition sort of to a higher inflation environment becomes a reality. So there is that danger that the Fed gets behind the curve and they need to catch up. At the same time, they need to catch up in an environment where economic data is still coming in persistently strong. Because on the other side of the equation is if the Fed is catching up and catching up so fast that the result is a material deceleration in the economic climate, which results in a pull forward of recession prospects from 2023 to current, or a much deeper recession than anticipated, then the market will have to balance that risk with it. So it's not just about the Fed, which makes this climate particularly difficult.
It's interesting that Gina says it's not just about the Fed, because if you look at across the markets, you look at 2-year yield, you look at 10-year yields just higher and higher, strengthening a dollar, credit spreads even higher as well. Combine all of it, and you're looking at a financial conditions index that's going back and meeting some key levels that you saw back in 2020, back in 2018, 2013, you name it. A lot of significant levels being hit when it comes to that financial conditions index. Levels that in the past you've seen a lot of Fed officials kind of turn around a little bit. Most recently, 2018, Christmas Eve 2018, that hike that we saw, and then followed by 2019, where you saw a little bit of kind of a U-turn, for lack of a better term. Michael McKee, if we continue to see these kind of markets or this kind of pressure in the markets, what are the odds that the Fed does something similar?
Oh, they won't do anything similar. Those examples aren't going to really matter this time because the situation is so different with what's going on and the division between the demand side and the supply side in terms of problems for the Fed. We were just talking a few minutes ago about China and how supply chain problems may get worse again as Beijing starts to lock down. There's so much they can't control here that the fact that the markets get a little antsy and the fact that financial conditions tighten isn't going to change their view. Remember what happened in 2018? The markets stopped functioning. Right now, the markets are functioning fine. They're just going down. And the Fed's not going to step in to do anything about that. They'll keep an eye on whether or not markets are be able to function correctly and things clear. But if not, they're going to keep going for now because all the indications are that they are a little bit behind the curve, but the economy is really strong.
Okay, well, let's just play that out. Is the debate now, can we get inflation back to target? Or is the debate now, we need to get the inflation kind of down to somewhere near target, let's call it circa 3%, and if we do that, maybe we avoid a recession. What does a softish landing look like right now, Mike?
Well, I think you may have described it somewhere around 3%. They'd love to get a little bit lower, but what they don't want to do is push unemployment up significantly. Now, how high is significant? There's the old Somme rule that if you go up by half a percentage point in terms of unemployment, then you keep going into recession. But we're at 3.6%, and that rule has not been applied when you're that low. So let's see if the Fed can keep unemployment in the low 4s. That may be good enough to consider it a softish or soft landing if they could bring the inflation rate down to about 3%. But we're getting way ahead of ourselves in thinking about that. This is going to take time. It took a long time for the impact of the COVID pandemic to be felt, and it is still being felt. So it's going to take a while to get out of this.
Gina, hop back in here. Let's pose the same question to you. What does a soft landing look like? And is this the best market reaction that we're going to get given the circumstances?
Yeah, I think this is a really good question and a critical question. Our fair value model actually says we've priced a soft landing. What we haven't priced is a recession. Even a garden variety recession would take the S&P 500 down beneath 3,600. So we've priced for a soft landing. We've actually priced for the 2-year Treasury yield to emerge at about 2.5% over the next 12 months. So if you have rates moving higher faster than to the 2.5% level, or you have economic growth conditions anticipating a much deeper contraction in growth as opposed to just a slowdown in growth to near zero, you've got a much weaker market climate ahead. And I think that that's what investors are trying to figure out, is handicap the prospects for that right now. Most economists are saying, hey, we're not going to get a recession until 2023 at the earliest. The equity market has to move to anticipate that if it is going to occur.
3,600 on the table. We're looking at a stock market right now just shy of 3,800. Thank you, Bloomberg's Michael McKee and Gina Martin-Adams of Bloomberg Intelligence, as always, for your insights. Coming up, we're going to stick with the market sell-off. Jay Barry, JP Morgan head of U.S. government bond strategy. Well, he joins us next. This is Bloomberg.
I think about Friday's CPI print as the Fed's bigger boat moment. So you may recall in Jaws, there's this moment in time where Chief Brody is chumming and he actually sees the great white shark for the first time and realizes it's much bigger than he had anticipated. And he uttered to his shipmates, we're going to need a bigger boat. Friday's CPI print was that bigger boat moment, and that's why markets are reacting the way they are, because they believe the Fed is going to be forced to get more aggressive than they had expected.
Great way of looking at it. Christina Hooper, Invesco's chief global market strategist, a little earlier on Bloomberg Television. Takes us back to our question of the day. Are markets ready for 75 bips? Joining us now, Jay Barry, JP Morgan's head of USD government bond strategy. Let's call it dollar bond strategy. Let's talk a little bit about 75 basis points. Are we going to need a bigger boat, Jay?
Hey, Guy. Good morning, and thanks for having me. I think, our thought process is, well, not necessarily sure if we're going to need a bigger boat, but maybe we just need to be thinking about the boat moving on for longer to try and avoid Jaws. And, our base case at JP Morgan has been, as the Fed has guided us, 50 this week and 50 basis points in July, and the risk of a series of more 50s after that. But certainly, I think the inflation data on Friday, though it showed CPI decelerating year over year, it's the fact that it's the more persistent parts of the basket that are related to the labor market, they actually firmed. And the fact that the shelter price numbers actually saw their firmest run rates of the expansion are somewhat worrisome to us. So it definitely runs the risk that the Fed needs to keep going at larger increments for a longer period of time.
Jay, one of the hallmarks of this market has simply been financial markets, investors front running the Fed. 50 basis points a couple months ago was seen as unheard of. Are we in the same moment with 75 basis points or even 100 basis points, which has recently seeped back into the conversation?
I think for this week, it's hard to think that the Fed will go more than 50, right? It's already conditioned us to think that it's going to go 50. I think one thing in discussion as the Fed's been raising rates more recently is a desire to not to surprise markets. And the fact that it's in its self-imposed blackout right now probably makes it challenging. But I think it's going to be pretty challenging for the chair to thread the needle on Wednesday afternoon. If he sort of doesn't leave the door open to 75 at some point or a larger incremental move, that means that he risks inflation expectations becoming less anchored than they are. And, you look at something like 5-year ahead, 5-year tips break-evens, they're basically consistent with 2% PCE right now, but you'd run the risk of them rising. And we certainly saw what happened with the Michigan 5 to 10-year ahead expectations on Friday. But if he does sort of quell any notion of a larger if he doesn't quell that notion, then certainly the market could price in not just a 75 at the July meeting, but maybe a series of successive 75s, because I'm not sure how the market would interpret that off ramp right now.
Jay, is that what is necessary to convince the market that the Fed is no longer behind the curve? How big does the number need to be in aggregate? And I guess probably what we're talking about here is, where does it take us to? Where is the terminal rate? What does the Fed need to deliver here to convince the market that it is not behind the curve, that it's got this inflation problem and it will control it?
So I think it's interesting, Guy, that you look at forward real policy expectations, and finally with the move that we've had over the last couple of days, you've got things like real Fed expectations 1 year forward and 2 year forward dipping back into positive territory, which I think finally makes sense. And one of the things that we've been focused here on at JP Morgan for basically the whole year is that you went out a year forward and 2 years forward, that those real policy expectations were still in negative real rate territory, and they're finally emerging from that. So I think the market's starting to say that we need to get real rates back into positive territory over the next couple of years, and that's with pricing a terminal rate of something like 390 right now. So perhaps that's what it's going to take to kind of get us there, which is getting policy rates, at least in nominal terms, something like 150 basis points higher than the Fed's neutral rate, all considered.
So let's stick with that story of nominal yields, because how much farther can we really go? If you're looking at a bear market for treasuries that just continues, we're looking at a 10-year yield of about 3.29 right now. How much farther can that go? How much higher can those yields get?
Yeah, so we've actually hit our year-end targets basically today. So I'd like to, say I can go home for the rest of the year and sort of call it a year. But in reality, I think you look at it, the reason we're here is because the market's pricing a terminal rate of very, very close to 4%. We would argue that when you look at valuations through the lens of how the market's pricing the Fed and growth and inflation, that valuations have started to emerge as slightly cheap again. But I think there is reason to think that we can continue to overshoot because the magnitude of this cheapness and this dislocation from our sort of fair value framework is modest. It's not extreme as we saw this time a month ago. And second, I think the other big piece of the puzzle here is that the positioning in U.S. fixed income is very light. I think as yields approach 3%, many of the structural shorts in fixed income were sort of reduced, and the markets had gone to focus on monetary policy in Europe and what was happening in core European government bond markets. So part of the reason why we've moved so aggressively over the course of the past couple of days is that the positioning's been pretty light and people haven't been prepared for this. And at the same time, something that we've been very focused on is liquidity conditions. They've improved a little bit, but they're still pretty weak from an historic perspective. And we're still sitting with liquidity conditions that are as bad as they were this time in the spring 2 years ago, and really where we were at the worst of the financial crisis in 2009. So these moves are getting exaggerated as well. And I think it's hard to say with very little to sort of understand until we get to the Fed meeting on Wednesday what's going to stop this for the very near term.
Jay, it's not your wheelhouse, but how much attention are you paying to what is happening in high yield right now? The Fed is unlikely to be that concerned with the equity market story, but if we start to see cracks there, is that going to change the narrative?
Guy, I think we're very focused on what's happening in financial conditions broadly and not just in high yield. I think you've clearly seen across spread asset classes that there was a pretty nice recovery from where we were at the wides in the middle of June to where we were just a few days ago. But kind of in the words of my colleagues in credit research this morning and credit strategy, we've been making narrower sort of higher lows and higher highs here. So I think the risk would be that there is some very near-term credit widening. But our overall picture here is that the fundamentals in the credit markets are okay, which should sort of prevent a full-scale widening, and that's why our forecasts across those spread products are somewhat narrower than current levels.
Jay, you mentioned financial conditions, and immediately my ears perked up because a big chunk of the movement you're seeing there is coming from the stronger dollar story. You focus on interest rates, you focus on the bond story, but how much should we be focusing on the danger associated with that strength in the greenback?
I think it's a big piece of the puzzle, but my guess is the Fed would actually welcome this, right? Because if we've been sitting here looking at the inflation number surprising to the upside and from the more persistent parts of the basket to the extent that the dollar strength would actually slow growth and actually slow inflation over time, I think that on a standalone basis the Fed would probably welcome. But I think for the very near term, again, if we're thinking about the Fed having to move perhaps more hawkishly than the market had anticipated, that it's going to be harder for sort of the dollar to stop over the very near term.
If the Fed comes out and signals 50-50-50 rather than 75-75-75, Jay, how does the market react Wednesday? I think the very short end guy would perhaps rally on the back of that just because we had the relief of the Fed not delivering a 75 this week. But looking at the way we're priced at the very short end of the curve, I mean, again, we're pricing in 175 basis points of tightening over the next 3 meetings. I think that would probably induce a relief rally at the front end because we didn't get it. But again, I would be more concerned about the move in longer term yields because if the market's saying the Fed's got the green light to go a larger incremental move at some point but doesn't produce it, then we run the risk of inflation expectations moving somewhat higher. And our medium term view here at JP Morgan is that inflation expectations in the market in the form of tips break evens are at risk of a Fed that's forced to move into restrictive territory later this year. But locally, we'd actually argue that valuations look a little bit cheap. So if the Fed doesn't deliver something bigger, and as you say, sort of keys us towards a series of 50s beyond next week, then I think the risk is you'd see longer term yields move higher, the short end relief rally for a short period of time.
Jay Barry of JP Morgan, thank you as always for joining us. More conversation coming up next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The German government is reportedly preparing to lend billions to rescue a former arm of Gazprom, now under the control of the country's energy regulator. A bailout for Gazprom Germania could come this week, with a state-owned bank expected to issue a loan. The money would help ensure supply security after Russia curbed shipments in retaliation for Germany seizing the company. Lloyds Banking Group will pay staff more money this summer as the cost of living spirals in the UK. Britain's biggest mortgage lender will make the one-time payment in August to more than 64,000 employees, covering all staff apart from senior executives. That's according to an internal memo seen by Bloomberg. Prices are rising in the UK at the quickest pace in 40 years. And a software engineer on Google's artificial intelligence development team has gone public with claims of encountering sentient AI on the company's servers after he was suspended for sharing confidential information about the project. The Alphabet unit placed Blake Lemoine on paid leave last week on claims he breached the firm's confidentiality policy. And that is your latest business flash. Grady.
Ritika, thank you as always. Let's get a quick check on these markets here, because red on the screen, the sell-off is continuing. You're not really seeing a ton of respite really for the broader market. The S&P 500 down to the tune of 3.3%. Of course, the Nasdaq taking it harder, just shy of 4%, and the Russell 2000 down 4.2%. There's a lot going on in these markets, but how much of this is driven by the rate story? Take a look at some of the yield moves here. 10-year yield at 329 basis points. Even the VIX here is much higher given the volatility. But to me, the question is, what are you not seeing in perhaps the commodity market? Oil prices, for example, only down 1.5%. In a risk-off mood like this, you would expect the commodities market to move more, but perhaps it's really only reacting more to the dollar. That dollar strength story continues. Japanese yen hitting 135 earlier this morning, and of course we know that the euro here getting crushed at 104. We're going to keep you apprised on all of that. Coming up, though, investors pricing in a more aggressive Fed. We're going to speak to Austan Goolsbee, former chair of the Council of Economic Advisors. That conversation next. This is Bloomberg.
I think we were at a crossroads back in mid-May. We wrote a piece titled that, saying that if the market kind of broke below the 3,800, 3,850 type level, exited growth scare territory, that we'd be pricing in a full recession. We bounced back, and we're right now right back at that crossroads.
That was RBC's Lori Calvasina earlier on Bloomberg Surveillance. We're about an hour into the U.S. trading session. The selling continues. Bloomberg's Abigail Doolittle is tracking the moves. Abby.
Well, Creedy, that was a really interesting question that Lori Calvasina just raised, because it is critical support 3,800, more specifically 3,810 or thereabouts, at least on the S&P 500 E-mini futures. Here you can see we are below that level, and we are also officially in a bear market for the S&P 500. The question is, will we close there, or will we rise back above important support? We'll taking a look at one chart that we'll be talking about that a little bit later on. But as for bear markets, the Nasdaq 100 and many other markets have been in a bear market or down more than 20% for quite some time. The Nasdaq 100 leading the declines, down 3.7%, and it, of course, is now down about 32% from its peak. So a brutal bear market there for the Nasdaq 100, and not a brief one either. It's a long, slow bear market, suggesting that there could be much more to come. You have the Nasdaq VIX, or excuse me, the regular VIX, or that fear index, gauging uncertainty up back above 30, not at panic levels, but it is a significant rise. Of course, the pressure for all of this, inflation fears, yields rising, that two-year yield up 16 basis points at an extraordinary 3.23%. Just amazing. And of course, that spread to the 10-year narrowing and narrowing, suggesting the yield curve could flatten or invert once again. That, of course, is a harbinger of some sort of a recession at some point. And one of the culprits here for risk selling, that Bloomberg dollar index up 0.9%. Really very interesting, the technicals happening there, whether or not it will take out its last high. Now, if we flip up the boards and we go to our next element, we are going to see that rising dollar creating problems for a lot of companies. Microsoft not not so long ago, pre-announced the downside on for profits, talking about the headwinds relative to the rising dollar. Here is a look at the companies most exposed to foreign revenue, and surprising to me at least, most of it's big tech. We of course do have Deere here at 43%, but Salesforce.com, Microsoft at 50%, Alphabet at 54%, Meta at 56%, Apple at 58%, MasterCard at 64%, and then the winner here, if you'll call it the winner, depending on what time period it is, NVIDIA at almost 84%. So this is another big pressure, a piece of the rates rising story, pressure on tech, because of course, as rates rise, typically the dollar is going to rise too. Now, rounding it all out with our last element here, and we take a look at this, it's pretty interesting, a consolidated way of looking at it. The S&P 500 foreign revenue exposure down 21% on the year. The S&P 500 U.S. exposure down 11.1% on the year. And of course, the S&P 500 itself, the way we usually look at it, Guy, down 20.9%. But this right here shows you just how critical the dollar is in what we're seeing relative to stocks. So it's going to be so important to see whether or not it can take out its last highs. Very close, but not yet.
Yeah, it's interesting you kind of fold that into the story that is happening here in Europe right now, Abigail, where we are seeing some aggressive selling in European bond markets, kind of reflecting what Abigail's talking there about what is going on with the dollar. BTPs, Italian 10s, now through 4%, back through 4%, I should say. And that is a big and critical line in the sand. In terms of the spread, you are now seeing over Germany, and we are still seeing a sell-off in German bunds today. We are now trading 236 basis points over Germany, so BTPs over bunds. That is a key metric for fragmentation in Europe that you want to be paying attention to. Isabel Schnabel of the ECB is going to be giving a speech tomorrow night at the Sorbonne. Pay attention to that speech. It's going to give you an idea of where we sit currently with the ECB and its thinking on fragmentation. We need to tighten up our thinking around what the ECB is going to do next. We may get some clues at that speech. But the euro is under pressure. We're back down into the 104s, tracking back down. Pay attention again to that. If the ECB is doing one thing, the Fed is doing one thing plus one, and that is going to be the critical issue going forward from here. If the Fed is delivering 75 rather than 50, where does that leave the ECB? So really critical things to be watching out for right now. But as I say, the sell-off in European govies really accelerating. Allianz's Mohamed El-Arian says the US inflation rate could go higher from here. Recession risks are lifted in a negative way. He was talking about that over the weekend. He spoke to CBS's Face the Nation yesterday.
I think you've got to be very modest about what we know about this inflation process. And I fear that it's still going to get worse. We may well get to 9% at this rate.
Austan Goolsbee, former chairman of the Council of Economic Advisors over at the White House. He, of course, is currently a professor at the University of Chicago Booth School of Business. Austan, great to have you on the program. Mohamed's talking about 9%. How high do you think inflation could get?
You know, I certainly hope that it doesn't go in that direction. I do think you got to split it a little in the way the Fed does between core inflation and then what's happening with energy and food prices. The energy and food prices is heavily coming from what's happening with the war.
Sure.
On core inflation,
Austan, sorry, that's fine. But if you take a look at Friday's numbers and you take a look at what all of the measures of core inflation are telling us right now, they're telling us that inflation at the core is also getting super sticky and is likely to be so for a long time. So, yeah, we may not get to 9%, but we are tracking in the direction of inflation getting broader, not narrower.
I think that's exactly right. That's what I was going to say is the disturbing part about the last report wasn't the headline number, 11 of the 12 months of which we already knew. It was that core inflation did not slow down by very much. It was down only a tiny bit, and it spread especially into rent and housing because we haven't had supply. I think the next 3 months, month-to-month inflation reports on the core are going to be the paramount critical thing that both the Fed is looking at, and for whether we get a sense of, is this going to go away, or if not go away, is this going to diminish now over time, or are we bundling it up into expectations, and we're going to have to go consult the ghost of Paul Volcker?
Austin, some of the components of this inflation, it's not, to your point, just coming from, and to Guy's point as well, from those food and oil prices. It's also coming from things abroad, things that can't necessarily be controlled, things like shipping rates, things like tariffs over in China. What can the U.S. administration actually do to tackle things that perhaps might not be within American borders?
Well, we could get rid of the tariffs. That would make prices go down. The prices went up pretty substantially on a bunch of these international products when we put them in. But other than that, the parts of the inflation that come from geopolitics or that are coming from worldwide supply chain disruptions, those are common across most of the advanced world. I mean, you just had the segment a few minutes ago about inflation in the UK being running at the highest rate in 40 years. You got the highest inflation in Japan in 40 years, highest all over the world. So there's not a lot you can do other than correct mistakes like the tariffs that were in place already.
Also, does the Fed have to correct some past mistakes? And how high do you think rates have got to go to correct that? The impression certainly given by the market at the moment is that the Fed is still behind the curve. Does the Fed need to be more aggressive here?
I think the Fed was behind the curve. At least a year ago, it was clear we weren't going to have the meltdown that they feared in March of 2020. So it would have made sense to move back to a position like normal. But the only thing for the most vocal critics who are saying the Fed should raise 10 times, even from here, and be hyper aggressive, is it makes a big difference how much of this inflation you think is coming from supply shock and how much is coming from demand. The only tool the Fed has is to raise the interest rate and reduce demand for interest sensitive things. That's the only tool the Fed employs. So if you think this is predominantly inflation coming from too much demand, then that can work. But if you think a lot of this is coming from supply, all you do by raising the interest rate and raising unemployment is you generate stagflation. You can't really get rid of the inflation by having high unemployment. So the Fed has got to balance that out and is going to have to keep an eye, as I say, on the next 3 months of numbers to get a sense of, is this supply, is this demand, is it starting to fade on its own as the stimulus rolls off, or are these events in the war going to just keep piling on to us?
Austin, let's talk about the dollar here, because as we talk about inflation, the dollar gets stronger and stronger. If you're the average American taking a trip to Europe right now, that's a really fun, easy, and cheap, I should say, trip to take. But if you are an American exporter exporting food, oil, that becomes a big, big problem for them. How quickly, or has this already happened, to that the dollar has become a problem for the United States?
It's definitely a problem for exporters, as you highlight. And I would also point out that a large fraction of world trade, including trade that is not with any country in the United States, two other countries trading with each other, uses the dollar as the currency to do the transaction. So as the dollar is going up, it is going to have a negative impact on U.S. exports, and it is going to have a negative impact on trade.
Austin, can I just come back to the point you were just making just a moment ago about the cause of this inflation and whether or not a lot of it is down to demand or there are other factors? What is your best guess on that? How much of this is demand, do you think?
I think at least 50% is supply. I think demand was a serious issue, but that in a way, what matters is always the delta from last year for GDP accounting purposes. And so a big government spend in 2021 of $2 trillion becomes a minus $2 trillion in 2022. And even if you think they saved part of the money, the fiscal drag is going to be a big number. So the Fed has got a difficult position in which they're trying to figure out how hard do we step on the brakes, how much is going to break on its own because of that fiscal drag, and then how much pent-up demand is there for services? Are people going to go twice as long on vacation because they have had to go for a couple of years without going on vacation? Are they going to go back and get their teeth cleaned twice as frequently, or get all of those elective surgeries that they skipped during COVID? Questions like that, we have no data to look at in the past because we've never had a services-driven recession before. but that's going to matter a lot for how hard the Fed steps on the brake.
Austan, you went right where I was going to ask you next, but I'm curious about what the breaking point is there. If you're looking at what some of these markets are selling off on, is this baked-in assumption that the average American consumer, and arguably the consumer around the world, can't handle the inflation, can't handle the costs that are being passed through? What evidence is there that they can't handle it or aren't handling it?
Yeah, I don't. There's kind of two minds. One is the view that what's happening in markets is they don't think consumers can handle inflation. The other is the market thinks the Fed is going to raise the rates a whole lot and maybe more than the economy can handle. And that's the thing that's going to drive us into recession. And as you start to see the yield curve inverting, it's going to be more, there's going to be more fear on that side of the ledger, I guess I'd say. So far, there's not much evidence other than consumer confidence measures are very low. But there's not much evidence that people's behavior has changed because of inflation. Consumer spending is still one of the stronger parts of the economy and has held up pretty robustly.
Okay, given that, Austin, what is the greater risk right now from the Fed's point of view? Doing too much or doing too little?
It definitely feels like the risk is recession. And the Fed may be doing too little, given the history that they have been doing too little. But as I say, if you get escalation of the war and the supply chain problems, or you get a resurgence of COVID or monkeypox, they find out is turning into a pandemic, any of those things, I think, make it all but inevitable that we will have another recession. Let's hope those don't happen and that we get to, the Fed gets to try to sort out the how hard to brake, how hard the accelerator problem.
Austan Goolsbee, professor at the University of Chicago Booth School and former chair of the Council of Economic Advisors. Thank you, as always, for joining us. We always appreciate your time. Coming up, Bitcoin plunging alongside the entire cryptocurrency complex in addition to the broad sell-off. We're going to dive into it next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, Eric Knudsen, the Neuberger Berman multi-asset CIO, joining Bloomberg Television, 3:30 p.m. New York time. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. What did former President Donald Trump know about the attack on the U.S. Capitol, and when did he know it? Those are the questions facing a House committee as it sets out today to prove Trump was directly and even legally culpable in the insurrection. The panel says Trump's claims that the 2020 election was stolen were investigated and litigated, and that he was told that they were not true by people in his own government and family. Bill Stephen, who led Trump's 2020 re-election campaign, will not testify as planned today. The panel says Stephen has a family emergency. Hong Kong saw COVID-19 infections amongst overseas travelers jump to a pandemic record after authorities there eased border restrictions, which led to a surge in international flights. The city reported 104 imported cases today, the second straight day the figure has hit 3 figures. Health officials there say the recent increase is still within expectations. And Chinese military officials in recent months have reportedly told U.S. counterparts that the Taiwan Strait is not international waters. That is said to have caused concern within the Biden administration. The U.S. and allies say much of the strait constitutes international waters, and they routinely send naval vessels there during freedom of navigation exercises. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Bye, Ritika.
Bitcoin plunging, hitting its lowest level in about 18 months. Joining us now to break it all down, Bloomberg's David Pan, who covers digital currencies. David, thank you as always for joining us. We're looking at a 22 handle on Bitcoin right now. This was supposed to be the asset that was an inflation hedge. It was supposed to be the asset of the future, the protection of the future. What happened?
Yeah, I think the pattern has been more and more clear that, the crypto market is heavily influenced by the macroeconomic environment. If we look back to the second half of 2020, we see that's when, Bitcoin is skyrocketed. That's exactly when the U.S. government started the stimulus packages, and then like there was like massive inflows of cash and liquidity into the crypto market, and now we're seeing the reversal of that, and then like the price is now in decline because of the sharp predictions for the interest rates in the coming month.
Just a headline crossing the terminal just a moment ago. Total crypto market value now falling below 1 trillion. This according to CoinGecko, David. So that's out within the last few minutes. So we're now kind of going below some really key levels here in terms of the total value of the market. What happened earlier to Celsius? What happened earlier to Binance? Can you just walk me through whether these moves are temporary or whether or not there's going to be a longer lasting effect?
Sure. So for Celsius, I think one of the biggest triggers for the crypto lender is that a lot of people rush to the platform to withdraw their Ethereum, and then that actually caused kind of like a lack of liquidity for the platform, and then the platform had to pause the withdrawals for their users. In terms of Binance, I think there was a new investigation regarding Binance involvement with the stablecoin Terra, which collapsed several weeks ago. So those two appear to be the biggest catalyst for the bear market right now.
And of course, we are looking at Bitcoin once again. It's down almost 17%. David, this is crazy to witness, but I'm wondering, do people look at this perhaps as the way they might look at stocks, and that this is a buying opportunity, or has Bitcoin perhaps lost some of its appeal to its broader investor base? Very quickly here.
Yeah, so according to some of the market participants, they think there might be a small rally in the near term, but like the general trend, in the long run, it wouldn't be. It would still be in the bear market.
Okay, David, we're going to leave it there. We're going to continue to watch what's happening here. Some critical lines being crushed, I guess you could argue, for Bitcoin and other assets today. Some problems in terms of withdrawals, certainly exacerbating the situation. David Pan, thank you very much indeed. The European close is nearly upon us. Let me talk to you about some of the price action we're watching and what we're going to be talking about in the next hour. European equities are under pressure, maybe less so actually than what we're seeing over in the United States, but the Stoxx 600 down, now trading just north of 400, 411. We're down by 2.63%. We saw some terrible data out of the UK a little bit earlier on, a negative monthly print on the GDP front. A lot of that down to the withdrawal of things like track and trace and the vaccine story. So a lot of it's healthcare related, but nevertheless, the momentum in the UK economy not good. The dollar going from strength to strength. We're back trading 121, 121.30 for the cable rate. We're just sub 4% on BTPs right now. 3.988 is where we are trading. We got through 4% just a few minutes ago. We're backing off that a little bit. Fragmentation, a key question that we're kind of watching very closely here within Europe. Isabel Schnabel is going to give a big speech tomorrow at the Sorbonne tomorrow evening. We're going to watch that very carefully. She's going to talk about fragmentation risk. So we're certainly going to want to find out about exactly what is happening there. In terms of what we've got coming up on the European close, Pooja Kumra is going to be joining us from Toronto Dominion Bank, TD Bank, senior European rate strategist. She's going to be talking about this very issue that we're facing here, trying to figure out exactly whether or not we are going to be seeing fragmentation in Europe in risk, and whether or not actually we are going to be finding ourselves in a situation where the ECB does need to react. We've definitely got a problem now for the ECB that the Fed looks like it may be going a little bit more aggressively. European markets certainly watching this debate very, very carefully. But it feels at the moment over in the States that we're watching what's happening with high yield. We're also watching what's happening with the equity market. Over here, it feels very much like the rates risk is absolutely front and center. What is happening with the gilt story is interesting, big move there. But what is happening on the continent quarter periphery is really worth paying attention to. And that's the story that we're going to be focusing on next. It is impacting what is happening in the foreign exchange markets. The Stoxx 600, a certain reflection of this. But I think over here, Kriti, it is a very different story to the one you're watching over there.
It absolutely is, and I think that's going to be one of the main themes, the idea that the entire world is on different policy paths, the PBOC, the ECB, the BOJ, and then throw in the Fed. Who's actually leading the charge in an era or in the last 10 years where the Fed has really been the driving force guy?
Absolutely. The European close is coming up next. All of this in focus. This is Bloomberg.